Well, good morning, everybody. Welcome. How is everybody doing on this Friday?
Great.
Good. Excellent. So
y'all are troopers. Thank
yes,
you.
Absolutely. Last day of the conference. This is my second time moderating a Friday session, and I'm actually I'm very happily surprised with the audience that we have, which is great. But it's a nice opportunity because a little bit more casual than when the seats are packed. So this is going to be a really nice opportunity for us to have a dialogue today versus us sitting up here talking to you and at you. We want to have a conversation. Our style is sort of, if everybody, I'm going to date myself, remembers the Phil Donohue style of talk shows, where we had someone up on stage and Phil out in the audience. So I'm going to be your moderator and your host today. My name is Joe Kiernan, and my co-host and co-moderator is Lucas McCurdy. So Lucas, say hi to everybody.
Hey, everybody.
So Lucas will be going around. We'd really love this to be a little bit more of a presentation and a little bit of a town hall. So Lucas will be coming around with a mic. If you have anything to add to the conversation that we're having today, that would be great. If you have any questions, please feel free to raise your hand. We're going to interrupt, and we're just going to have this have a nice free-flowing dialogue today. So welcome to the session. We really appreciate that. Would like to take and welcome our guests and for today's session. We have Leanne Barney. I'm going to have her speak a little bit about herself in a moment. We've got Jim Thompson from BOK Financial. And then, of course, my co-host, Lucas McGarty. There we go. Yes, exactly. So we are your hosts in your panel today. So Leanne, tell us a little bit about yourself and about Trilogy Health.
Sure. I'm the CEO of Trilogy Health Services. I've been with the company for 19 years. When I started, we had 2 facilities open, and so very much a growth company. We have 116 open today. We do more of a continuum of care on our campuses, skilled nursing, assisted living, and independent living with memory care. So all services provided on most all of our campuses.
Excellent. Welcome. Jim?
I'm Jim Thompson. I have been a senior debt lender to skilled nursing and senior housing for over 30 years. I know I started when I was 10. Worked for essentially the same team, developed a very strong viewpoint with respect to evaluating operators to invest in from a senior debt perspective. I learned from one of the best in the industry. Have recently taken an opportunity to move to BOK Financial, to hopefully take that 30 plus years of experience to a younger organization in the industry. And I'm so far so good, and I'm looking forward to continuing.
Excellent. And Lucas, maybe tell everybody a little bit.
So I'm essentially the Phil Donohue, evidently. So if you see me staring at you directly in your face, that means I want you to ask a question. So I'm Lucas McCurdy. I'm the founder of the Bridge Group Construction, and I'm the proud co-host of Bridge the Gap, the Senior Living Podcast. I'm glad to be here. I'm glad you're here too.
Excellent. And a little bit about me. Again, my name is Joe Kiernan. I am the Chief Strategy Officer and Senior Vice President of Network Development for a post-acute company in New Jersey, mostly in New Jersey, called Ocean Healthcare. So we have a portfolio of skilled nursing, assisted living, 4 hospice companies. We're actually just going into Michigan, as well as Ohio, Pennsylvania, and New Jersey. Skilled home care, private duty home health, behavioral health, an array of different post-acute services. So coming from the operator side, both in the institutional setting, but also the service lines, and how do you make all of that kind of work together, not only for our customers and our residents, but also really working horizontally across all of those different business lines so that we can support an internal network. So I'll be kind of also jumping in on the operations and the operator side of this. Just by a show of hands, how many operators do we have in the room? Excellent. Okay. And then on the investors, finance side? Okay. So we've got a nice mix. How many mostly in seniors housing for our operators, seniors housing and skilled nursing? Okay. And then service lines, do you have anybody on the home care, hospice, ancillary services? Awesome. Excellent. Very good. So we've got a nice mix here. And we did have a little bit of a change up. The coronavirus has stopped some people from traveling. So I would really like to thank especially our guests today, Leanne and Jim, for being here and taking the time and the risk apparently to travel. So we really do appreciate that. Thank you so much. So as you read in the program description, there's never been more disruption in our industry, where it's become more and more difficult for operators to really be able to demonstrate the strength and their core competencies to the stakeholders that are involved in their businesses. So, how do you demonstrate to an investor that you have the strength to be able to run a successful operation? And then on the investor and finance side, how do you know what questions to ask? Jim and I were having a conversation earlier. The times have changed. The questions you asked, years ago are not the questions you ask today. The folks in the operations that you used to talk to are not the folks that you want to talk to now. To really get a sense of, are you going to be investing in a physical plant, a building, which doesn't really exist anymore. It is about what you're doing and how you do it. So we're going to kind of hit on a number of those topics today. We picked out 3 key or core areas that we wanted to focus on. And again, if you have any questions or anything else that you'd like to bring up, please let us know, and Lucas will be walking around with you. So let's get into one of the biggest things is our regulatory focus and some scoring. So as we know, they're in skilled nursing and on the post-acute side for the most part, although this does exist in hospice and home health. However, I don't believe my experience in operating both home health and hospice, the consumer hasn't really relied on that public scoring quite yet, at least on the East Coast and in our region, as much as they have on skilled nursing. I think everybody who's being referred to a post-acute healthcare center or a nursing home knows Nursing Home Compare, goes on there, takes a look, and they look at those 5 stars. You have everything from your overall scores, your health inspections, a multitude, huge amount of your quality measures, and staffing. So what does that information tell a consumer about you? And how, as an operator, do you have to worry about that and really take a look at what's happening relative to that scoring? There's also been, CMS put out a new warning symbol. Everybody saw that coming, or at least I hope you did. The red circle with the stop hand in there. So if you are cited for abuse, neglect, or I forget what the third one in abuse, neglect, or exploitation. If you get that tag during a complaint survey or a survey, that hand goes up. I don't really want to even begin to think what happens to an operation that has that on the website. I'm thinking occupancy is going to decline significantly. Admission volume would probably go down to nothing, and you're going to get dropped out of any preferred provider network that you're in, because they usually use the 5-star scoring as a quality measure. So that is a huge way of affecting what it is that we do. So from that perspective, Leon, can you speak to how your team at Trilogy manages the expectations of that public reporting, and how do you make your investors, your lenders, feel more comfortable about how you're managing that?
Right. Well, I think that I agree with you. Increased regulatory focus has been something that we've seen in the last several years, but it's not something that we haven't dealt with continually as skilled nursing operators. The difference today, I believe, is that the information is so much more available to our consumers via the internet. And so we're not just dealing with the regulatory Nursing Home Compare and 5-star ratings, but also we have to deal now with Yelp and Google reviews and other just consumer comments that'll be posted online. So what we've always taken the approach is to be very close to our customer and to our consumer. When 5-star ratings first came out, I would say that most of our consumers didn't understand those. So we took a proactive approach to have talking points and explanations that our operators could use to talk to our current customers via newsletters, family meetings, and however we could educate them if they came in to talk to us and ask, well, what does this mean? You have a 3-star rating. We could, have the talking points, because we all know that as perfect as you want to be in operations, there's going to be blips that will happen. And so you may have a negative survey outcome that you want to be able to explain that this isn't a systemic problem. This was something that occurred because of an isolated incident. Or if it is a systemic problem, how are you addressing that? And so at Trilogy, we stay very close to our current residents and then also our communities, our referral sources. And then from an investor standpoint, I believe that we try to be very proactive in educating them on what's going on in our business. We don't take the approach that we're going to hide anything. If we do have a survey issue or regulatory issue, then we're very open with that. We talk about it to them, and then we tell them how we're going to manage through that process and what we're going to do. They also are very savvy. They understand that it isn't, a 5-star rating isn't everything that it looks to be all of the time. And so they know that, if we talk through, and if we have to take our lumps, we take our lumps on things. But I think it's best to be honest and be out there and be explaining that to your investors and your consumers.
Exactly. That's great. I know for us, we're constantly looking at what the impact is going to be. So if we see we've got a facility that's getting ready for survey, and we know that we are in year 2 of the 3-year cycle, and we're getting ready to get that bump that we finally need. Survey readiness for us is going to be huge, really making sure that we're prepared for that because of the impact that has and the trickle up effect on your overall rating, and then being able to have those conversations with your bankers, with your investors, especially if you take a hit, giving them that heads up early. So Jim, on the finance side, how do you handle that side of the equation? So when you're looking at one of your investments or on the debt side, whichever you might be on, how do you kind of navigate the strengths or weaknesses of your investments?
Joe, as a senior debt lender, our evaluation of an operator, especially an operator that we don't have experience with, the window to do that in the time that we're given to make a go, no-go decision and then get the loan closed, it's really shorter. So while we've evolved over the years to have conversations about details about survey preparedness and whether or not operators use these analytical tools that predict where 5-star may go, those are just now sort of entering into our regular discussion with prospective operators. When 5-star first came out, and I still have my own views about the value of 5-star, and I'm sure it's shared by many of you in the room, but it is a reality. Fortunately, the organizations that I've worked for have let the team with the experience and the contact with the operators really make the decision about whether you move forward with a transaction on a group of properties that may contain some 1 and 2 stars. So from that perspective, I feel very fortunate that I can have those communications with my customer or my prospective customer. And if I'm satisfied with what happened, if there's transparency, as Leanne had talked about, then I'm still at a point as a lender where I can go to my credit people and tell that story and feel like I'm going to be supported in that decision. Prior to 5-star, when we were evaluating transactions in skilled nursing, we used to hire third-party clinical review teams, and unfortunately, we stopped that when 5-star and other means of getting information. And let's face it, our group had a lot more experience evaluating operators, so there was less reliance on third parties to do some kind of review. I am a little concerned about this warning. I have never had a loan not pay or I lost $1 because of 5-star or any other regulatory issue or any liability issue. But I think what's happening here with the addition to the potential special focus list and the addition of this caution symbol, when you take it in the context of everything else that's impacting skilled nursing and senior housing, you really have to take more time and effort in understanding, sort of how much volatility can the property take, how much volatility can your operator's portfolio take, and do they have the capabilities to react in the capital, not just debt capital, but overall capital, to do what they have to do potentially over a year or two period to fix a problem. So that's sort of how I look at the impact and how those that reporting and public information has changed my view of the necessity of getting information.
So this is not really even just a financial pro forma anymore that you can put on an Excel spreadsheet. This is what's your operational plan? How do you handle that level of clinical and operational risk, and being able to see, do they have the smarts to be able to pull this off?
That's correct, Joe. 30 years ago, when I was making skilled nursing loans, the operator evaluation was always at the top of our list. But the evaluation was so much easier. I liken it to the appraisers assuming a competent manager in their valuation. And the historical financials were really the key, unfortunately, to our estimate of quality as an operator. And skilled nursing lending was a math problem back then. Mostly Medicaid. Most states had a Medicaid capital component, so we tied that to our decision in terms of whether the amount of senior debt was appropriate. Clearly today, lending to skilled nursing and senior housing is no longer a math problem. We have been on an increasing arc where that decision, the debt and investor decision, is more of an art than a science. And I really think while there's a lot of tools available and a lot of data available, when it comes to evaluating the operator, it is clearly an art. And in the limited time that we have to make that decision as a senior debt lender, I really want to probe the viewpoint of the operator, get a sense for their skill set, and whether what they're doing to prepare for this continued journey from fee-for-service to value-based squares with what I think the success factors are. And rightly or wrongly, if those things match up, then I give that operator really high marks, because some of those things are things that need to be done in the future. There are other alternatives, so you're not evaluating the operator's specific performance over a period of time in these new metrics, but I'm evaluating their preparedness, what's their viewpoint on taking risk, how they intend to be successful. I want to know if I'm talking to an operator and making a lending decision with someone whose buildings are going to become commodities, whose buildings are going to lose value over the term of my loan, versus operators in skilled nursing and senior housing who are going to be adding value to the underlying real estate and their enterprise.
Excellent. That's great.
Joe, I'd love to jump in here because I'm really impressed with the mix of people that we have in the room. And so I'd love to get some feedback on the scoring system from either an operator or a lender. I know that there's some thoughts and feelings on this, so I need somebody to pipe up and ask a question. Of course.
You can always count on Lynn.
Lynn, please tell us your name and your company.
I'm Lynn Katzman, and my company's Juniper Communities. My question deals with KPIs, so key performance indicators, and they can be anything from hospital readmission rates to medication errors. And I wonder in the evaluation of the operator, whether you ask for those KPIs, because those in and of itself might be an indicator of readiness for an operator.
Lynn, I would say that I don't have a list of KPIs that I walk into a meeting with a prospective operator, but I understand.
Just have them.
Well, beyond that, our discussions revolve around hospitalization rates, revolve around the partnerships that they have entered into, revolve around their readiness to participate meaningfully in integration and care coordination. Because if I go into a skilled nursing meeting with a skilled nursing operator, and I get a sense that they're operating the way they did 10 years ago, then the meeting's cut short. Thank you very much. Very nice to meet you. I hope that I see you in 5 years. So.
I would agree. I think in our organization, obviously that's how we run our business every day, and it's not. I would say it's beyond in today's day and age more than just your clinical KPIs. I think labor, as we all know, staffing has been a challenge for everybody in our industry. So I would also be asking how they manage their labor, not just labor dollars and wages, but how are they looking at turnover? Do they know where their turnover is happening, why it's caused? Sometimes it's by market. So they really need to have a good pulse on all of those things, labor. And then also the customer experience. We focus very heavily on our customer experience and the metrics that we have along those lines. We track how many people eat their meals in their rooms. And that's an indication to us as if we're going to have good food service scoring from our customers. So every area of the business you have to have today, I believe, to run your business, good metrics and data.
And Lynn, I'll jump in on the operator side as well. We do have a set of those key indicators. We actually measure in all 8 divisions of the company on a weekly basis some of our key performance indicators that help us identify what our month is going to look like from an operations side. But when we're sitting down with one of our primary lenders and they'd like to know how things are going, we really point that out. So we really survey readiness, the results of those, the depth and strength of our clinical teams, and how they interact with operations. Really looking at who our administrators are and our leadership in our buildings. Of course, the financials always speak for themselves, but and then things like how do we what networks are we participating in? What's our bench strength on the payer side, whether that be with managed care participation, also looking at our participation in preferred networks or strength. How are we managing that to be able to attract new customers?
So is that part of your presentation when you're meeting with lenders?
Yes, absolutely. Yeah. Lucas, do we have
Anybody else?
any other questions? Anybody have anything to share maybe from your experience in terms of readiness?
Oh, cue the music.
Excellent, cuties. Okay. Well, we're back from break and we're ready to go. Actually, and we'll be back in a moment. Or who was it that we'll be back? 2 and 2. I think I'm dating myself yet again. All right, so let's talk about the ever-changing challenge of the healthcare dynamic that we have to deal with. So over the past several years, I think seniors housing, as well as our healthcare side, has experienced dramatic changes. Recently, we have new payer models, both on the skilled nursing side with PDPM, and we've got PDGM on home care. These are probably some of, when you've got a change in how you are paid and reimbursed for the services that you provide, that is a pretty dramatic change in how we operate on a day-to-day basis and how we manage expectations. In addition to that, we've got a significant growth of iSNPs within the senior care side of our business. Acute care preferred provider networks have been around. We talked about that a lot actually in our last year at the spring conference. That was one of the sessions that I was actually moderating and had a full panel of preferred providers, and both on the hospital side and the post-acute side. So how we get our business, how we get our referrals have changed dramatically. It's not about your medical director and his relationships and how many hospitals he's in anymore. It's not about the bagels that you bring in. It's about your outcomes. It's about what you can provide to a post-acute partner, and using the word partner as opposed to being a vendor. So that has changed dramatically. Outcomes, data, and performance as opposed to chandeliers and beautiful wallpaper. Yes, people want to be in a very nice looking healthcare environment and a senior housing environment, but what are the outcomes? How well are you doing? What is your your length of stay? What is your rehospitalization rate? So these are just some of the examples of the changes that we face on a day-to-day basis. So from the operator side, Leanne, how do you help your investors sleep a little bit better at night, understanding that you've got control of this? How do you demonstrate that?
Well, I'd say two things. One is overall strategy and your strategic plan as an organization. So as I mentioned at the beginning, we operate facilities that have a continuum of care. And strategically, knowing that a lot of this pressure was going to be coming from a reimbursement standpoint and regulatory, we purposefully have been shifting our mix more towards senior housing versus skilled nursing. And we've done that over the last 10 years to the point where we're almost 50-50 in our business. So we outlaid that to our capital providers that was something we wanted to do. We wanted to invest in more growth in senior housing because it's not as risky, in our opinion. Obviously, there's risk in everything, but from the reimbursement standpoint, it helps balance our portfolio a little bit. And they're very supportive of that, and we've shown that we've been able to execute on that. So I think executing on a plan, setting out the strategy and then showing them that along the way you've been able to execute and that the strategy was the right one. So whatever you choose as your strategy, being able to show that. From the point of networks and ACOs, again, we've been very customer focused. So while we have to be in that market and deal with those reimbursement challenges or the networks, we've also had markets where because of a 5-star rating, we may not be in the ACO. And so our focus on the customer and being the customer service leader of choice in our market has been very beneficial to us. We've haven't seen a loss in consumer demand in many instances, even though we couldn't be in that hospital relationship. So I think that's another piece of it. And then beyond that, I think the data is obviously the ultimate piece, being able to show data, be able to show your operators and your hospitals and everyone that you have the data, what your recidivism is, how you're working on that. But again, I really believe that the focus on the customer and the satisfaction, if you're a good provider and people know your reputation, then whether or not you're in a network may not matter, what your 5-star rating may not matter as much. I'm not saying it doesn't always, but it's going to give you much more opportunity to overcome those things.
That's great. Excellent. So, Jim, like we talked about before, these are not the same questions that you used to ask.
Absolutely.
Learning all of the, ROI and NOI were probably the two major acronyms or the letters you had to have memorized.
Right.
Now, PDPM, PDGM, ACO, BPCI, it's the list. I think actually CMS has a 150-page index of all of the what all of the acronyms and the letters mean. So with all of that being said, what kind of questions are you asking? What are you looking for when you sit down with one of either an existing investment or especially when you're looking at a new one?
Well, it is different looking at a prospective transaction because again, that senior debt window is shorter. But I'm going to key off of what Leanne said because she talked about two things: strategic plan and data. Historically, I don't want to use historically, but way back when I was a young pup lender, our focus was on analyzing historical cash flow, right? Census was fairly stable. This is even before Medicare began creeping into the skilled nursing business. Yes, today, looking at historical performance is relatively important, but what's more important is what our estimate of future sustainable cash flow will be. And the way we get there is to really spend a lot of time talking about what is the provider's strategic plan. And again, does that square with what I think are the success elements that the business is facing today? The other, of course, is data. I have customer relationships that were evaluating hospital discharges, looking for pain points for their acute care partners or hospitals in the community, creating strategies, developing very robust data systems before it was cool. Those were the exception, and they're still I still count them among, the very top providers in our business. We have to see that becoming the rule as opposed to the exception. So in the limited time that I have to evaluate a potential operator, someone that I don't know, the focus, of course, is on what is their strategic plan? How do they see themselves succeeding, and what elements are necessary? And how do I use data? In particular, how do I use data to demonstrate my value proposition? I think I'm sort of making some mental notes, and I really think that my initial underwriting of a new potential operator, I really need to try to get a handle on this sort of network participation, and try to make a judgment about the relative success of an operator in network participation. And like the data that you say that you have, I should be asking in the provider's portfolio, sort of how have they measured their success in network participation, and how can I use that information to decide whether I want to make an investment in that operator.
And I think, for the operator side, we clearly have to know what with that network participation, what are the goals and objectives of that network? Are they going to narrow that network further? And what are the terms and conditions of continued participation? So if narrowing the network is going to be based on 2 key performance points, which is my length of stay and my readmission rate, which some could argue, contradict each other, I need to understand that, and that puts me at a level of risk as an operator, because if maybe I'm not quite as engaged as they want me to be, but I've got great performance data. I've seen centers be asked to leave a network. They had strong numbers, but they didn't engage in the process. Then I've seen facilities that were on their way up, really developing it, but they were asking the questions. They were going to the table. They were knocking on the door. They were asking for help. That's something I would want to tell my investor, to say, look, we're not where we need to be, but we're getting there, and our hospital partner thinks so too.
I've talked to a lot of operators that had 2-star buildings.
Yep.
In networks.
Yep.
Now, some of them were fortunate because there weren't viable alternatives, but the lion's share of them remain in the network because they go to the hospital with the kind of deep data that you generate, and it's that level of conversation between the referral source and the provider.
Right.
That is just way too deep for a senior debt evaluation of a new transaction, but these are conversations that I have during the sort of asset management phase when things change. In larger markets where moving in and out of network for either one of our collateral properties or another property that the operator has, those are the discussions we have. And would I like to have all those same discussions at the front end? I would, but the realities for a senior debt lender are different, and frankly, we're farther down the capital stack, so people a lot closer to that one more readmission, the impact of that one more readmission, have a much higher interest in getting that granular. I'm kind of a numbers geek. I'd love to get granular, but the reality is I have to make senior loans.
I think another point you mentioned was, do you want to be in that network?
Right.
And so I think the more data you have, the more you can determine if it makes sense for you to be in that network. But then if you have the data, you can have a little bit more of a voice in those conversations. So if you can go in and, as you mentioned, show your data. But I think sometimes as operators, we go in and are intimidated by the hospital network and say, well, we have to be in here and we have to do everything that they need us to do, even though it doesn't make sense for us, or it's just too much paperwork. I mean, we've been in networks where the business that we get almost isn't worth all the hoops we have to jump through. So if you have good data and you have a good consumer reputation, then you have a little bit more voice at those meetings, and we shouldn't be afraid to use that to negotiate what makes sense for us as operators.
Right. And you make a really great point, because I think the benefit of being in that network, that preferred provider network, high performance network, however they want to phrase that, has always been the continued flow of referrals coming into your building. Whether that be skilled, primarily post-acute is really where this lives, but we're seeing it more and more on the seniors housing side, especially in assisted living, where assisted living, there was some great data that Ann Tomlinson presented on Wednesday that showed that the readmission rates to hospital from assisted living and from skilled nursing were almost equal. And so everybody is talking to the post-acute side and saying, you're killing me here because we're getting slammed with readmission rates. We're losing reimbursement and revenue on this. But what about on the assisted living side? And so where do they fit into this network participation? They're usually, not going from hospital to assisted living. There's usually a stop in a skilled nursing or a post-acute setting first. Then perhaps because there was an event in their life, which unfortunately is when families and loved ones are making the decision to look at assisted living or an alternate care, home setting. So where are the assisted livings fitting into this? And you're right, where do you want to be? That's been the main driving goal, is that referral volume. But at some point, with all of this high performance, we've got great data, we're lowering our length of stay, we're lowering our readmissions, we're a great engaged partner, we have programs that match all of the major programs that the hospital are offering. It's at some point it's going to be time to go to the hospital and say, I want my share. So you're in all of these shared savings programs, where's my part of the check? Because I helped you do that. So at some point, like you said, Leanne, we have to really look at what's the strength when you go to the table. You go to the table kind of going, did we do okay? And as opposed to going to the table and go, no, we did great. And here's why. You need to narrow your network a little bit more because you're still sending 20% of your referrals to underperforming facilities when mine are exactly where they need to be. So Lucas, let's jump to the audience.
I'm really excited for several reasons. The candor of the conversation, but most excited about, we get to use the Nick talk box in the back.
Nice.
I have the Nick talk box.
Yes, you have to throw that when you're done. Right?
I like it.
All right.
High tech. Oh, here we have a tester. My name is Jenna Tapper. I'm a healthcare consultant in this space, and I have a master's in nursing and an MBA. So I look at the clinical and the financial. Right. Everything that you've said is absolutely true, but I would encourage you to do a whole market assessment on who the payers are. You talked about the narrow provider networks. I have like 5-star clients that are locked out because their costs were too high. They didn't have the data, even though they're number one in their market. You really need to find out where those referrals are coming from, who has the contracts. Yesterday, we heard there's going to be 80% Advantage, Medicare Advantage. You better find out who holds those contracts or you're going to have empty beds. And people want the one-stop shop, all the levels of care. And if you can't provide it, they're going to go somewhere else. So you really need to figure out what's going on with that healthcare contract. Make sure you're in that network. One of the 3 providers maybe they're collecting data on, you better work with them and be aggressive and call them up. Like I said, I have clients locked out because they didn't reach out to the health system where they got all their referrals. Too bad. So you got to be really proactive and be aggressive, like you said. Show your data, show what you can do, partner with them, come up with clinical pathways and protocols as a team, insist on ongoing meetings. You really have to do that.
Yeah, I would have to say I agree with you. Although Leanne and I had a very interesting conversation over dinner last night where we talked about do you want to be in a preferred provider network, but do you want to actually be in contract with a certain payer? And what's your positioning? And I don't want to take, because I'd really love for you to talk about this, but what's your positioning in your market and the demand for your service location, whether that be post-acute or seniors housing, and making those decisions? And it was a great example you gave.
Well, our approach has been that with our facilities, we aren't going to be in agreements that don't make sense for us. We have a one market where our marketing team is always saying, we've got to be in this network, we've got to be in this network. And it's such a low payer, even though it's a large provider and it's associated with the hospital system. But for us, it doesn't make sense. And so I'd rather go out and spend dollars to try to get the private pay customer, because we do have a good customer service reputation. In some instances, I'd rather have a long-term Medicaid patient in the bed. So, that's sort of our opinion about it, is that if you have the top-notch services, you should be able to make those decisions and say, no, we're not going to take that rate, and and then you hope that consumer demand will come back around in your favor at some point. But if not, it's in some ways better to leave a bed empty almost. I hate to say that to the bankers and the capital providers here in the room, but we've done the analysis on it, and so if it doesn't make sense for us, we're not going to participate.
That's a good point, especially with respect to long-term Medicaid. I think we're entering an era where the value of the long-stay Medicaid patient has never been higher. So I think that's a very valid decision point.
Yeah.
Clearly, I agree with everything that you said back there. From a senior debt perspective, it's way too granular for our analysis and evaluation of an operator. But you said something very key, which is you have 5-star buildings locked out of networks. And I've seen many 1- and 2-star buildings remain in networks. And so as a decision maker to make a loan, you really can't sort of say, I won't do anything under a 3-star, right? I've lent money to operators that were under corporate integrity agreements. I personally believe that if they have the right attitude about that process, they end up as a better operator at the end of the 5-year period. But that, I don't really want to digress. But that's why, for me, it always goes back to who I'm doing business with. Do I think they have the skill sets to manage a situation where they have a 5-star building that's not getting the loving that they deserve, or they have the ability with their data to take a building that is 2-star and maybe 2-star for 2 or 3 years because of a bad survey, and still be able to develop and maintain those referral relationships. So again, it all comes down to my evaluation of the operator from a sort of a global perspective.
Joe, we got a question back here.
Yes.
This is a little unrelated, but my question is around PDPM. A lot of the operations have received a lot of upside from PDPM, and I'm just curious from the investors or the lender's perspective, how are you looking at that, knowing there may be potential adjustment down the road?
Okay.
How are you looking at it?
I was going to bring this up when we were talking about the PDPM, and this viewpoint will obviously be short-lived, but my focus in evaluating a new transaction today with respect to PDPM is I want to make sure that this property or the operator's portfolio, their results are not outliers. I mean, if 4 or 5% growth over market basket is where they are, I'm feeling pretty good about that. And yes, I understand that there might be some adjustments. I'm hopeful that CMS will take the time to actually incorporate the outcome data to see if we're getting what they're paying for before they make any reimbursement adjustments. But right now, my focus is going to be on, am I really talking about an outlier? Because the risk of a top line reduction, a significant enough top line reduction to impact the debt at my level of the capital stack is real.
Lucas, do we have anybody else from the audience?
Anybody else on this topic?
Anybody else have any experience or insights on this? I wanted to add one other thing when we were talking about really being able to get to the table. Very interesting, and I would have to say, not to put her on the spot, but Lynn has probably experienced this, Lynn Katzman. For our organization, we have a few buildings that are participating in an ISNP with a very large national player, and I'm not going to use anybody's names. And wanting to have further conversations to say I'd like to expand the a commercial contract and not only just the iSNP piece of it, but we'd like to have a bigger part in this where I can capture maybe some more of that more profitable post-acute patient into the skilled nursing side of what we do. And you can't get to the table. And then so now we're saying with iSNPs coming into skilled nursing and operators kind of investing in iSNPs or starting their own, which our organization invested in one, and we're now rolling that out in our buildings for ourselves. Guess who came calling? And so now they want to have a meeting. And now they want to have conversations. And so the dynamic of that conversation, just like we were talking about certain payers and whether you really want to be in that it just doesn't make sense. And they came calling because people wanted to come to your buildings. And now but you're not in network and their members are yelling about it. So where do you sit with that? And so your strategic plan and your focus on how you're going to approach that changes the dynamics of those conversations. And I can't wait to go to that meeting. I think that's going to be a lot more fun than my last time. So excellent. All right, we'll be back in 2 minutes. All right. The next thing, let's talk about, shifting from seniors housing to healthcare. I've learned to be very passionate about this from someone who I know very well and for a long time. And I've seen it happen in my own organization. We've talked about this when looking at your portfolio, and it has been a consistent thread throughout this entire conference. The spring conference really talked about how healthcare and services has become so necessary in the seniors housing piece. If we continue to think about this as a real estate deal, there's that part of it, but that's not what this is anymore. So as we continue to shift and look at senior housing and healthcare, there's been that whole shift up and down the upstream and downstream components of what we do. So, skilled nursing, we've become the new hospital. Our post-acute units are not post-acute units anymore. They're med-surg units. They're literally even step-down units. Expectations of doing
direct admits from the community.
Exactly, direct admits, especially in an ACO or a BPCI situation where you don't even need a hospitalization. You can just directly admit. Where assisted living has become the new nursing home, so to speak, where home care is the new rehab. So with all of these shifts and and even looking at independent living, where before it was just an apartment with some amenities, and if you fell, the most they could do was call 911. Well, how do we avoid the fall in the first place? Because it's just gonna keep going and going. So based on this whole shift in this market, and especially everything we've been talking about over the past few days, so Leanne, how does Trilogy prepare for a meeting or having a conversation with your investors that demonstrates your core strengths in be able to look at either a multi-million-dollar deal or how you're handling your existing debt with them and your ability to make the appropriate changes, especially on the seniors housing side of your portfolio?
Well, as I mentioned earlier, we did set a strategic plan several years ago to shift more towards senior housing. Being that we've had a continuum of care always on our campuses, our assisted living and senior housing has been more clinically focused. I think as I said, everybody's talking about this shift more toward clinically focused in senior housing. It's one thing to say that you're going to do that, but you really have to be prepared to provide the services. And so from our perspective, we would showcase, the leadership that we have in place clinically and how that marries well with the skilled side of our business that we have into our senior housing. So we already have that knowledge. And do we have the staffing in place to be able to provide those services? What kind of nurse staffing do you provide in those environments? I think you have to show ongoing what education you have for nurses. Things are changing rapidly. With PDPM, before PDPM, we would tell the hospital, do not send us anybody with an IV because we didn't get paid for it and it was very expensive. Now we're saying, give us IVs. We're calling the hospital saying, we can take them, come on. But you have to have staff that's trained to be able to do that. So you have to have a system in place to be able to, whether it's through technology or on-site resources, to provide ongoing training and clinical competencies to make sure you're staying up on all the trends that are happening.
So let me ask you, because this was a question I actually didn't get to ask in the previous session, was when you're looking at, and you said you've shifted more towards senior housing, how have you been able to balance the senior housing selling proposition of maybe a lifestyle, the amenities and services that are available, so that your residing customer, the senior, and particularly their family, feel really wonderful about where mom or dad or whomever is living, and balance that with the healthcare side? Because for years, it's been chandeliers and wallpaper and carpet and all of that. And now it's the healthcare piece, because mom wants that, but she also has 2 or more ADLs and about 5 comorbidities that we're dealing with. So how do you balance it?
Well, I'd say that we still do provide the chandeliers and the amenities and the dining service, and our life enrichment is very vibrant, and so you sell that. But from our perspective, if we're selling against someone who's a standalone senior housing, our position is going to be, look at the care that we can provide. Mom can stay in her home longer, which is what she wants to do. You're not going to have to move her. And if eventually she does decline, she's going to be in the same building and be able to move into a skilled setting with people that she knows, the same therapy providers, the same caregivers, and then also, friends that she's made along the way. Right. And so that's been a big part of our marketing strategy over the years, is that clinical advantage that we feel that we have had in our business. And so we can provide all the hospitality, but we also can take care of you.
Okay, excellent. So
we got a question right back over
excellent.
here.
All right. Good morning.
Mozzie Sargosha with Premier Senior Living. As this shift happens, we all know we're becoming more and more targets of class action lawsuits for big players and series of additional lawsuits for small operators. How do you evaluate financially that massive risk factor where ultimately your GLPL, your NOI, and the entire organization can be at risk with these kind of, let's call it nonsense claims that come across? And the big elephant in the room yesterday that was brought up is, in fact, the trial attorneys that are making this a more and more difficult operating environment. Mm-hmm. And so how do you protect against that? How do you model that in financials?
Great question.
I'm seeing a lot of head nods over here.
It's like yes. Yes.
It's a great question, and to be frank with you, we don't feel like we have the capability to model that. But to your point, just last month, 2 more providers settled with the Department of Justice over the issue of too much therapy, and now with PDPM, we're going to start seeing key TAM and other suits that allege too little therapy. But before the therapy issues, it was the utilization of nurses, the documentation of nurse time. It was back when when Medicare was cost plus, and it was long allocations for cost report purposes. So there's always been a suit du jour that hung over the skilled nursing lending. And as I mentioned very early on, in my 30 years of experience, I've never lost $1 or not had a payment made because of a regulatory problem. Now, I guess that's better to be lucky than good, I guess. But again, it goes back to who you do business with. I don't want to do a single owner operator, single facility or 2. I don't think that there's the capital, the cash flow, and the resources to be able to handle that. I mean, I was a lender to a number of companies that after the end of a 10-year period had spent $5-6 million in legal bills, defending their claims, have had to pay 10, 20, 30 million dollars to settle the claims. And yes, they didn't want to do it, but it didn't bankrupt the company. It didn't impact the assets that I'd financed and their performance and their repayment. So I don't think I can model what you're talking about, but I don't see a reason for it, because in the way I do my senior lending business, I don't see a correlation between those gross events and the ability to get repaid on my senior debt.
I would say from an operator, we are fortunate that 3 of our 4 states are not very litigious, but unfortunately our home base is in Kentucky. Which is, as everyone probably knows. So I'm going to go back to something that's going to sound very simplistic, but I think the customer relation is still very important in this process. We have a very strong outreach to our customers, and we monitor every incident that happens in our healthcare center or our assisted living with falls and wounds, those type of things, and falls with injury, anything that could be potential liability, we escalate that immediately. And we have an outreach where we talk to the families and we say, you know, I don't think most families get into this to go and sue you, especially if you provided great care for their family and you have a good relationship with them. I think it's when that breaks down and they don't feel like they've been listened to, or that something has happened that you haven't met their service needs. And then that's when the trial lawyers can grab onto them and it makes for a great case. But taking great care of people. And then we have a good track record that we can show to a lender that over the years, I think if we only operate in Kentucky, which some of our competitors have done, and they've exited the state, that would be a little bit more challenging for you guys to look at. But having this large spread among other states, and it sort of minimizes a little bit what we have in Kentucky, even though it's our biggest area of liability, even though it's our smallest state that we operate in. So, but I think you can't discount that importance of staying in tune with your customers and your families very regularly.
So how do you scale that based on your size? So, because I've got 13 skilled nursing and a couple assisted livings. You've got 120, 130. So, how do you take that concept and make that work over that kind of an enterprise?
Well, it starts at our campus level, and we have several of our service standards that are related to communications with our families. One's called a family call program. And so we reach out to them very regularly on admission, and then 30 days we try to talk to family members that aren't in our campus as often as others, so that if a concern comes up, we are made aware of it right away and we can address it. We log all of our resident concerns, and I tell our campuses all the time, if you don't have very many resident concerns, you really aren't doing your job, because you should have a number of those. We want to know every little concern, and then we go back and follow up on it. And then again, as I mentioned it from a clinical standpoint, we have a system that we call it red escalation. So any event, our EHR will help escalate those events up to us, even through our campuses. If a family makes a threat of something, we want to know about it right away, and we get involved immediately to try to mitigate anything before it gets to the point of litigation.
Right. And you can kind of see that, and we do have a question in the audience, but you can kind of see where what Leanne just explained to us would be so valuable to explain to one of your investors or to a lender. To just I would sleep much better at night knowing that you've got those systems in place, and there's still the risk, and you're still going to have those issues, but you're doing everything you possibly can to mitigate it. And Jim had mentioned it earlier. It's not necessarily that not only that you're doing it, but you understand it, and that's great. We have a question.
Yeah, I just want to make a comment on the operational model or shifting from seniors housing to healthcare. I've been in the industry a long time and have done many models, many facilities. And so we're experimenting with a new model, which I think is kind of interesting. I'll try to explain it. It's in Maui, Hawaii. So not a bad place to build anything, but it takes a long time, like most places. But our model is this. It is basically a continuing care retirement community. It has a 40-bed subacute skilled nursing. It has a 39-unit memory care ALF. And then we have what will be 150 independent living units, which is not unusual in the vernacular of a CCRC or life plan community. But here's where it gets interesting. So in our community, we're an island. I don't think most people operate on an island, or maybe you think you do, but this is a national island with an ocean around it. So it's a unique community, and it's really got one acute care hospital, which was state-owned, and Kaiser took it over. And basically all acute care on this 160,000 population island with 300,000 visitors every day, also a very unique situation. So we have a unique and kind of a closed system. We have one provider who's large. Certainly everyone knows Kaiser, at least in the western states you certainly do. So what we've done is we're partnering with Kaiser to build, and I think this is kind of interesting, a critical access hospital. It's going to be about 1 to 5 beds. It's going to be about 15,000 square feet, and it's going to have a 24-hour emergency care facility, maybe 1 or 2 operating rooms, and full clinical capacity on campus. So to me, in the concept of continuing care, and you want to work with a large provider, in our case there's only one, so it isn't like we can go shop around or we can say, oh, we don't want to use them. Well, they're it. That's all there is. That's all the acute care on this island, which is a pretty good sized place. I mean, you think 160,000 people, one hospital, 200 beds, and you have an incredible visitor population, a very unique situation. But we're excited about it because we think it addresses these issues. And the partner I have on the operational side, a company called Greystone Communities. They're obviously well-versed in the area. They actually have built a continuing care retirement community on the island of Oahu. But I think even they are doing now, their continuing care retirement communities that have an acute care service on campus in partnership with probably the largest or one of the largest providers in the community. So I think that's a model that, maybe as we look to build in the future, as we look to finance in the future, this may be something that can work. And I think we have a good petri dish to try it, and a really nice ocean view too.
So can you dissect that down to a simple question?
A question. Do you think that's financeable? No.
Well, I was going to say, because Jim and I sit on the planning committee for this conference, for the spring conference together. And I don't know, that might actually maybe make it to the conversation table for next year to see, do we have those? How do you grow outside of this maybe box that we currently sit in? I don't know.
Well, clearly you don't want to be forced out of your network.
No,
that would be a problem. In terms of traditional debt financing, there's a lot of issues that aren't on the positive side for us. Size of the property, dependence upon maintaining on a long-term basis the relationship with Kaiser, the size of the project. Investing so many dollars in a large project is very difficult for all but the largest of debt lenders, and I don't represent one of those. So I think the choices to leverage your project to get the equity returns needed are much fewer than they are for a lot of other developments or financing opportunities. Now, I'd love to consult with you. Go to Hawaii.
I'll go too.
Yeah, I was going to say, if that happens, I'd love to maybe
I'll jump on board.
move from the Northeast to see what I could do on the business development side for you. So Lucas, we actually, I got word from you earlier that our session this morning has gone viral. So tell us a little bit about
maybe our poor choice of words.
Well, and actually, Leanne and I have great infection prevention policies and programs in place to deal with that. Which, as a lender, you would really want to know how we're handling that. So, although the coronavirus is another story. So we've got a huge following going on. Tell the audience a little bit.
Sure.
About
So I posed our topics and our questions in this panel on LinkedIn, and many of you are on LinkedIn. So I got a question from a really respected person. Many of you may know Aaron DaCosta. He is now the Chief Strategy Officer at Solutions Advisor Group, and here's his question. He says, given the pressure on pricing due to consumer expectations and local market oversupply, pressure on expense growth due to wage and insurance increases outpacing inflation, and an aging physical plant in need of refresh to regain its original Class A appeal, how have capital partners and operators been able to reset expectations on margin and CapEx spend levels, yet deliver expected returns to investors?
I think that this is where it's very important, and you're probably going to say the same thing from your perspective, but it's very important who your partner is and that you have an understanding of what you're trying to do in your business. We've been very fortunate with our capital partners, have been very generous with us to reinvest in our properties. They understand that not investing diminishes the value of their business. You're going to lose census, you're going to have market share. So again, they've been very strong with that. So I think the lesson there is to make sure that you have that relationship with your capital partner, that they do have that understanding that you're going to have to reinvest continually in your business, especially when new builds are coming into the market. You don't want to get left behind with your real estate. So that's my perspective, is it's got to be a good two-way to understand. I think
absolutely
you guys do.
And as a senior debt lender, I would prefer making a loan on a property that may be at that point where we can see that making an investment in the physical plant will give it legs in terms of the market for many years, certainly beyond the term of our loan. So I like to provide those proceeds in my financing. But I think the other side of that answer, and that's sort of a traditional sort of senior housing, how do you make those decisions, and how do you exist within the market? Those are more traditional senior housing questions and concerns. And I think where we're trying to go here with this third portion of our little discussion is that I'm also taking into account the very real potential for top-line growth in senior housing, particularly private pay senior housing, by meaningfully dealing with the health of your residents. Let's face it. I mean, residents in private pay senior housing and even independent living, given the age and the chronic conditions that they have when they enter the facility, they are one step away from adding functional mobility problems to that list. And if you've been at any of the sessions since this conference started, you'll know that that's where the costs really start to grow. And that's where senior housing, private pay senior housing, has a huge role to play. So there is an opportunity on the top line that would afford you the ability to maintain your physical plant, provide additional services, have healthier and happier residents, and increase value. A friend of mine said some half a dozen years ago that private pay senior housing is absolutely the hub of caring for the health needs of our frail elderly. And while that was a new concept to me as a lender who had focused on skilled nursing, but also had done a lot of construction lending in senior housing and refinance and acquisition, I have come to be a huge advocate of the role that senior housing will play in impacting the Medicare spend. Mm-hmm. And by doing that, those operators and those facilities can generate value. And the sort of traditional blocking and tackling and things that you need to do with the resident base, especially with the expectations of the adult daughters as they go into senior housing, the amenities and all that, you'll be able to do that better. The offerings to your residents can improve if directly or indirectly you are maintaining their health and wellness. Not taking care of their medical care, but really focusing on their health. So that's the side of that question that I thought needed to be addressed as well.
I think we have a question over here.
Lynn? Yes.
Lynn again. So we talked about CapEx in
Yes.
regard to investments, and you talked about the the advantage that seniors housing has in preventing the onset of issues that require hospitalization. So let's talk about technology and investments in technology, particularly on the senior housing side, because technology, particularly if you have an older building, means infrastructure, means software, means continuing training to get there. And that doesn't happen overnight. How do you view those type of investments? And do you help people make those type of investments?
Great question.
I'm going to answer that question. It's got two parts. One is how I personally view that investment and the value of that investment. But when you work for a bank and you make real estate loans and you're subject to all the requirements of your regulators, you have limits in terms of what loans you can provide and how much leverage you can provide against that property, regardless of where you think the value is going to come from and the cash flow is going to come from. You want to avoid having a leveraged loan classification, or any of what I'm learning are hundreds of buckets of bad stuff that banks have to deal with. So I think that we don't do a good job as lenders in being able to provide solutions for that kind of lending. Is it absolutely critical that a subset of us do? I believe that to be the case. And I also believe in the value that those investments will create. And again, as I mentioned before, I don't want to make a loan with an operator that's not doing these things, because I don't want their skilled nursing facility or their senior housing facility to be a commodity in their respective market.
Excellent.
I wish I had a better answer for you.
My producer is telling me that it's time to go for questions. So do we have any other questions or comments from our audience? Any other personal experiences that maybe you've had that might give either a lender or an operator some insight on how to interact with each other? Yes, sir.
You're all baby boomers, so you're kind of a target upcoming market. Are you all going to move into age-segregated housing?
Mic drop.
Age segregated housing. Okay.
I think I either need to look a little bit more like my headshot. So I don't know that I was a boomer, but
I wonder how many years Nick is going to let me get away with using that photo.
Yeah, I know. I think I'm over it. I don't think I'm done. So with that one, you know what, sir? I don't. For me, I don't know. I'm a little too. I think I'm a little too far away from having to make that decision. Thank God. But I would say, you know, for example, my mother, who is 72 years old, she lives in a retirement community. It is an age-restricted 55 plus, not really an active adult community where they've got the whole big clubhouse and all of that. Just a 55 plus retirement community. And for her, it was just the right move from a housing perspective. But it's her own freestanding home. There are no services outside of taking care of the lawn and all of that. I'm the one who goes to her doctor's appointments, all of that. I do start to get concerned about how she would do at home. We took out the bathtubs, we put in showers, we made things much nicer so she can extend her time at home. I don't know. I think it's sort of like I've spent my entire life in healthcare. I've spent the past 20 some odd years in seniors housing and skilled nursing. So I don't know if I want to spend my retirement years in the same setting that I've spent my entire career. But so my answer is, I think what we can do and what we're going to build for our upcoming generation who's going to move in, the answer should be yes, but I'm not there yet.
I think one thing I've learned from being in our industry for a long time is that the importance of taking care of your own wellness. I think that's more our generation is looking at that. I don't think the previous generations that we've cared for that have been in facilities for the long term probably had that same focus, and they didn't have the resources toward it. I mean, nowadays everybody wellness checks, go to the doctor, take care of yourself so you can live longer, and that's why you'll see the shift toward people living in more independent living, and our skilled facilities are really just that rehab. I wouldn't have a problem rehabbing in any one of our facilities. Both my, well, not both my parents, but my mother and father-in-law were in our facilities, and so I'd be a hypocrite if I sat up here and said that I didn't feel that we provide excellent care, and I'd have my family there. But again, I'm a little ways away from it, but I can see the social aspect and of what we're building in senior housing and the amenities and it being a good lifestyle that you may want to have at some point.
You see your residents as failing in some way, and so you don't want to be failing like these failing people.
As far as what I'm speaking about is
now as a resident, but and I found that by having moved in, which I did for various reasons, but not because I was failing. I've lived there 14 years, and you can see I'm still reasonably healthy. But I didn't expect to be treated like a failing person. So I'm asking, what can you do to keep your residents still involved so that they're not just isolated away from the larger community and just, we don't like to see people who are dying, so we segregate them away and don't have to look at them too much.
I don't see that as much. I think years ago that was the case in our facilities, but now, as I mentioned earlier, we build a continuum of care facility. And when we first started building, we had separate entrances for assisted living and skilled nursing because we thought the same way that you're thinking, that people don't want to interact. Now we have what we call our town square model, and it's completely open. And we find that the residents do interact and they have activities together. And so I see that that's changing. And I think my mention was not to say that someone was failing, but that just people are being more advocates for their own health now and trying to be more active. And so that's why you're seeing people staying in senior housing longer, because that's their home and they're being active and maybe don't need as much care as the previous generations. And
my observation is you don't want to be like that. You're not ready for that.
No, I think as seniors housing operators, as well as investors, I think what we have a responsibility to do is to put our seniors and the folks that we care for up front and center. And they are our most valuable asset. They're the people that we care for every single day. Behind every single one of the numbers on a spreadsheet is a person. And so we've all said, I've heard it said a couple times during the conference, it's one of our mission, part of our mission statement is do the right thing for the right reason, and the money follows. So we're going to continue to do the right thing for the right reason for the people who live with us now and the people who are going to live with us in the future. Ladies and gentlemen, that's our show for today. What I'd like to do is a big round of applause for my co-host, Lucas.
Thank you, Phil.
A really special thank you to our guest today, Leanne. Thank you so much for taking the time to come out. Jim, especially jumping in. Thank you so much. Really.
Thank you.
Thanks, everybody, and be kind to one another.
Safe travels.